The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the Wilkin & Gutton Plan webinar titled PPP Loan Update, Changes Under the Consolidated Appropriations Act. My name is Jessica Kisman and I will be moderating today's webinar. As this is a continuation of our Payroll Protection Program webinar series, you will recognize Bill McDivitt and Len Nitty, who will be speaking with you today. There are a few housekeeping items just to keep in mind. There is a questions panel in your GoToWebinar dashboard on your screen that if you have any questions throughout this presentation, that you can submit your questions and we will try our best to get to them at the end of the program. If time does not allow, we will do our best to contact you after the program today with a response. The slide deck itself is available in the handout section of the GoToWebinar screen that you are seeing in front of you. Just as a reference, this material and the discussions today are ever evolving, so please be aware that the information discussed within this webinar is accurate as of this morning, January 7th. Lastly, the webinar will be recorded and available on our website, wgcpas.com, along with the slides for the presentation shortly after today's program. Please also visit our website for the previous P3 webinars, as well as other resources that may be helpful related to COVID-19 and the latest updates. For our agenda today, we will be discussing the Consolidated Appropriations Act related to changes to P3 loans, the Simplified P3 loan forgiveness process, potential increases in initial P3 loans, qualifications and rules for second draw PPP loans, as well as the employee retention credit. Now I'd like to turn it over to our first speaker, Len Nitty.
Thank you, Jessica. So I'm going to be talking about some general changes to the PPP program, and then once we get through my section, we'll turn it over to Bill to discuss the second draw PPP loans and the employee retention credit. And just to echo what Jessica had said earlier, you know, this is all current as of today. As we found when the program first came out and evolved over time, this program is subject to change, and the changes can happen very quickly. So, you know, stay in tune with what we're doing. We'll send out alerts as necessary, and also may have some additional webinars if changes are significant. But as she said, everything is current as of today. So I just wanted to echo that because these are subject to change. So first thing that I wanted to talk about was, you know, the covered period and how the covered period is determined. When the PPP legislation was first passed, everyone had an 8-week covered period where they had to spend the funds to qualify for forgiveness. And then we got the PPP Flexibility Act, which gave you the option to choose between an 8-week covered period or a 24-week covered period. So you were stuck with one or the other. The new legislation, the CAA, gives the borrower the option to pick the end date of their covered period, as you know, and you can make this decision anytime between after hitting the 8-week period and before you hit the 24-week period. So if you decided to end your covered period after 10 weeks, you can do so and apply for forgiveness at that point. But just keep that in mind. Now there's much more flexibility in selecting the covered period, and this may be helpful to a number of taxpayers. The one thing that didn't change is that the start of the covered period will continue to be the date that the loan is originated or where the proceeds are distributed to the borrower. So we also had some expanded eligibility as part of this plan, and I'm just going to hit on the new types of businesses or organizations that qualify, and Bill's going to get into a more expanded detail of all the potential borrowers that are covered when he talks about the second draw loans. But included now are 501c6 organizations, as long as they have no more than 300 employees. These are going to be your trade organizations, your Chamber of Commerce, your business leagues, trade organizations, things of that nature. Also, news organizations are now included, including individual stations, newspapers, and not-for-profit public broadcasting organizations, as long as they have no more than 500 employees per location. Cooperative housing corporations, as long as they don't have more than 300 employees, and direct marketing organizations, which have no more than 300 employees. So a little more wide spanning this one. And keep in mind, because these are new organizations that haven't had a P3 loan before, they're going to qualify for the initial loan draw process, as opposed to the second draw, which Bill is going to talk about a little bit later. So the other thing that they failed to give us early on in the process and really never answered was they gave us special treatment for seasonal employers, but they never defined what a seasonal employer was. So it was really unclear who was going to qualify for the adjustments for seasonal employers. And we now have a formal definition from the CAA in terms of what this is. And seasonal employers are those that do not operate for more than 7 months in any calendar year, or during the preceding calendar year had gross receipts for any 6 months of the year that were not more than 33.33% of the gross receipts for the other 6 months. So essentially, to say it a little differently, if 75% or more of your gross receipts come in a 6-month period, you meet the definition of a seasonal employer and could potentially qualify for a different measurement period in determining the size of your PPP loan. And we'll talk about why this may become important to those that had original PPP or initial draw loans in a few minutes. So this is a big one, the tax treatment regarding the PPP expenses. And this is one where there was a disconnect between the intent of Congress and the president when they wrote the law and passed the law, and how the IRS interpreted things. So what the original CARES Act told us was that any amounts forgiven under the PPP loan process would not be considered to be taxable income. The IRS came out and interpreted that to mean that because this is tax exempt income, any expenses paid using these loan proceeds were going to be connected to tax exempt income and therefore were non-deductible. Congress and different politicians came out and clearly stated that was not their intent, but the IRS stood with this position because there was no legislative change authorizing it. Now, as part of this new act, expenses paid for with PPP loans are fully deductible. Not only are they fully deductible, the legislation has made it clear that there will be no reduction in tax attributes, meaning reductions in losses, tax credits, fixed asset basis, no denial of basis increases. This will apply to any initial or second draw PPP loans. And the IRS earlier this week issued Revenue Ruling 2021-2 to make all of their earlier PPP guidance regarding the deductibility of expenses obsolete based on the new law. Also to note, even though we're not discussing EIDL today, EIDL grants are also now treated as tax-exempt income, and additionally are subject to all these same rules for PPP expenses, where the IRS is not going to be able to make any expenses non-deductible or change any tax attributes or do anything along those lines. So this was very taxpayer friendly and very borrower friendly. So a lot of businesses are very happy with this news, and that they're not going to have to pay taxes on the forgiven amount of the loan, nor will they have to disallow any of the expenses that were paid using those proceeds. So really a win-win situation for the borrowers that qualified. Also, they made it clear when dealing with pass-through entities that these rules apply to partnerships and S corporations. It confirms that the loan forgiveness is treated as tax-exempt income, even if issued to a partnership or S corporation borrower. Also makes it clear that the tax-exempt income for the loan forgiveness will give an increase in basis for owners equal to the amount of forgiveness, and this will allow for the owners to deduct the expenses on their personal return, because it will create enough basis to do so. And this also will apply to initial and second draw loans. So very favorable, and Congress made sure that they made it clear that there will be no room for interpretation by the IRS here. So another thing that we got as part of the CAA was an expanded definition of eligible PPP expenses, and we've added 4 additional categories to what we've historically had. So we now have covered worker protection expenses, and we'll go into a little more detail on all these in a moment or two. Covered supplier costs, certain covered operating expenditures, and covered property damage costs. And we also got a clarification for covered payroll costs that, the medical insurance and benefits that are included will also include group life, disability, vision, and dental insurance paid for by the employer on behalf of an employee, not amounts deducted from their paychecks, but for amounts paid for by the employer. The one caveat here is that this does not apply to loans already forgiven before the date of the enactment of the CAA. So this is only going to be on a going forward basis. Covered worker protection expenditures. These are going to be operating or capital expenditures made to comply with requirements or guidance issued by governmental agencies, whether by the federal government or state governments. It's going to apply to costs for standards of sanitation, social distancing, or any other worker customer safety requirements imposed on a business or borrower. And it applies to guidance given between March 1st, 2020 and ending when the COVID-19 national emergency expires. And some examples of covered work protection expenditures, the installation of a drive-through window facility to allow for contactless delivery, air pressure, ventilation, or filtration systems, physical barriers such as the sneeze guard, expansion of additional indoor-outdoor combined business spaces, on-site or off-site health screening capabilities, filtering face piece respirators, and personal protective equipment are all examples that the law gave in terms of things that would qualify. One thing that they did make clear is it does not include costs relating to residential real property or intangible property. So covered supplier costs are expenditures made by an entity to a supplier of goods for items that are essential to the operations of the entity and are made pursuant to a contract order or purchase order that was in effect at any time before the covered period, or for perishable goods in effect at any time before or during the covered period. So a little more flexibility for perishable goods, where you can enter into new contracts or new purchase orders and orders and have those qualify during the covered period in addition to before them. So covered operating expenditures, this is going to be the payment for any business software or cloud computing services that, and this is going to be for anything that allowed you to work remotely or deal with things virtually from a business standpoint. We're using WebEx right now, but WebEx, Zoom, those types of software applications, different cloud computing, perhaps cloud storage platforms that you had to go to facilitate your business. But what it essentially says is any of this business software or cloud computing that would facilitate business operations, allow for a product or service delivery, processing, payment, or tracking of payroll expenses, human resource functions, sales and billing functions that you had to acquire new software or cloud computing services for, or the accounting or tracking of supplies, inventory, records, and expenses. So any expenditures that you had to undertake to adjust to become more virtual or automated as a result of this are going to be covered expenses that can be paid using PPP expenditures. And then we have covered property damage costs, which are somewhat narrowly defined. And this is going to be costs relating to property damage and vandalism or looting due to public disturbances during 2020. And the costs here only qualify for payment with PPP proceeds if they're not covered by insurance. So pretty narrow in scope, but wanted to at least make you aware of this as well. The other important thing to note is, although we're not going into great detail on how the program works today, because we've covered that in earlier sessions, just want to make note that it's still a 60-40 test in terms of how this funds can be spent, where at least 60 still has to be spent on payroll costs, qualifying payroll costs, and no more than 40% can be spent on non-payroll costs. So although these are all new types of expenditures that you can use PPP proceeds for, collectively with the other non-payroll costs, they can't exceed 40% of the loan amount. So in addition to a number of certifications that have historically had to been made on the applications for PPP loans, there's been additional 3 that have now been added. The first one is brand new, which is the applicant has not and will not receive a shuttered venue operator grant from the SBA. And the second 2 were in place, but you didn't have to certify to these. Now you're going to have to certify to these. First one being that the president, the vice president, the head of an executive department or member of Congress, or the spouse of such persons are not going to qualify for these loans if they hold a direct or indirect controlling interest in the applicant. The other one, which was not part of the initial legislation, but this is one of the changes that happened pretty quickly with the SBA giving guidance, is that the applicant cannot be a publicly traded company. So if the applicant has its securities registered or listed on an exchange registered with the SEC, you're not going to be able to take advantage of this program. So PPP loan forgiveness, a slight change to the amounts that can be forgiven is that EIDL grants that were given, these were the grants that were up to $10,000 for those that apply for EIDL loans. PPP loan forgiveness was originally going to be reduced by the amounts of the grants received. This is no longer the case as a result of this legislation. So PPP loan forgiveness no longer has to be reduced by these amounts. And very friendly in that any amounts that were previously deducted from forgiveness for those borrowers that have already applied for and received forgiveness, those amounts are now, it sounds like those amounts will now be automatically remitted to the lender by the SBA along with the interest due, so that those loans can be fully forgiven even if you had a deduction for the EIDL grants previously made for you. It doesn't sound like there's anything additional that you'll need to do based on the guidance that the SBA just issued yesterday and posted this morning. So that's completely up to date. So keep an eye out for that. If you've received loan forgiveness and had an EIDL grant, you're just going to want to confirm with the lender that this is happening for your loan, and you will receive the automatic forgiveness on those amounts too, assuming you otherwise qualify for it. So we also had an expansion of the simplified loan forgiveness process as part of the CAA, where we initially had a simplified process for loans of $50,000 or less. That's now been expanded to loans of up to $150,000. And the form's not yet been issued by the SBA, but it will include a one-page certification where you're attesting to the compliance with the PPP spending requirements and headcount. You're going to have to show and certify that the number of employees retained during the covered period qualify you for forgiveness, and that the amount of the loan proceeds spent on payroll costs will be or was 60% or more, and you're also going to have to designate what the original loan amount would be. So it will be a new form from the SBA, and we're expecting it to be very similar to Form 3508EZ, which is now currently in effect for those loans I mentioned under $50,000. So for compliance requirements, even if you're completing the simplified form, you should go through the calculations to make sure that you've met the requirements, since you are going to have to certify this. You will also likely have to provide some documentation to the lender to certify this. And you're going to need to keep the documentation of your payroll records for at least 4 years to support the application, and any other records for at least 3 years. The last one, which is interesting, is they're going to allow for increases in the initial PPP loan amounts in certain scenarios. And one of the problems created early on as part of this loan process is that the rules were changing quite often. And the guidance we had initially in certain areas changed quite drastically to either qualify businesses or borrowers for additional proceeds, change who may qualify. And if you were impacted by this, you're going to have the opportunity to go back and get an increase in your initial loan amount. So who may receive an increase in the initial loan amount? It's going to apply to loans which have not received forgiveness as of the date of the enactment of the CEA. So keep that in mind. If you've already gotten forgiveness, you're not going to be able to undertake this. But if you haven't received forgiveness, borrowers may reapply for funds if the borrower previously received and returned a PPP loan, or returned a portion of the PPP loan, or the borrower only accepted a portion of the initial PPP loan that they were entitled to. And the third one is the borrower would have been entitled to a larger loan as a result of the SBA interim final rules published after the date of their initial PPP loan being originated. The two big examples here are going to be one for the seasonal employers, and I kind of alluded to this earlier, where they changed the rules for seasonal employers to not have them go with the statutory time frame for calculating the maximum loan amount. You were able to select your period based on any period where you were busiest and we're going to have the most employees. And that left a lot of seasonal employers, even though they may not have known if they were a seasonal employer at the time, since there wasn't a definition until this act was passed. But seasonal employers may want to take a second look at their loans and see if they qualify for additional proceeds. And the other big one was for partnerships, where partners in a partnership were initially not entitled to receive any loan proceeds for their own self-employed income as a result of working for the partnership. And that was later changed in subsequent guidance by the SBA after many partnerships had already gotten their loans. So if you were impacting this and didn't initially get an increase in your loan amount, you could potentially consider applying again here for the increase and getting those additional funds, assuming you have not already received forgiveness. The SBA has 17 days to publish additional guidance here. They did issue and address this in the guidance released earlier today and dated yesterday, that they specifically cited the partnership example and also the seasonal employer example. There may be some other instances that this would apply as well, but those are going to be the two big ones. And in order to receive this increase in the initial loan amount, the request must be submitted by March 31st, 2021. So we're on a little bit of a clock there to get this money in. And Bill, this is probably a good segue into your discussion on the second draw loans, and whether or not it may make sense to even consider taking this increase in the original loan, or if you qualify, just moving forward with the PPP2 or the second draw loan program.
Right. So thank you, Len. You'll find out in a little bit why an application for an additional draw on your initial PPP loan may be a bit problematic as it relates to your second draw loan, but we'll get there in a moment. Thank you, Len. First of all, I want to say hello to everybody and Happy New Year. It's been a very, very, very strange year, going back to mid-March of last year. I think we were all shocked to suddenly discover that we were under rules that required us not to be leaving our homes unless we're essential workers. And while a lot of things have changed since then, a lot of things are the same. Many people are probably listening to this webinar from where they live, somewhere other than their normal place of business, but many businesses have got back in the saddle and are back in the office. and with the vaccine programs that are out there, hopefully 2021 will only get better over time. But as we sit here today, there are many businesses that are still suffering substantially, and there are many provisions within the new act that have been designed to help the most significantly impacted businesses. So one of the things that is in the act is this Payroll Protection Program second draw loan. So we've used the acronym of PPPSD to correlate with that. We've also been using P32 and other acronyms. If I make a mistake and slip to P32, you know what I'm talking about, the second draw loan. So as I mentioned before, this second draw loan is designed for businesses that have been, in general, harder hit businesses. They tightened and changed some of the rules in terms of how and who can apply for this. The eligibility for the second draw loan, the initial issue is that you can't have more than 300 employees. That 300 employees is subject to the affiliation rules we've discussed in previous webinars, and Len mentioned some changes there as well. The hospitality industry, which is the NAICS code 72, has exceptions for those rules to a per location count as opposed to an aggregate count for the employer. Those rules are similar to what was in the prior act, so I'm not going to go into those in too much detail. And then one other requirement to get a second draw loan, and there's been some confusion on this, so I'm going to stop on point 3 and talk about it for a little bit, is that the applicant or the business must have used or will use the initial draw loan in full by the time they receive the second draw loan funding. So I'll say that again. They must have used or will use the full amount of their initial P3 loan by the time the second draw loan is funded. So going back to Len's closing comments regarding the possibility to go back and ask for more on the initial round, if you are asking for more on the initial round and don't expect to be able to qualify for a second draw loan, that probably makes sense and you don't have any real prohibitions on it. But if you think you would also qualify for a second draw loan, you have to think as to whether or not you should be applying for an expanded initial loan. And it's not clear whether or not you can make the argument that you've spent the money related to the PPP initial loan, even the expanded loan, by virtue of the fact that you have qualifying expenses that you've incurred. So I wouldn't want anyone to put at risk the possibility of a second draw loan, and we'd have to discuss with anybody who thinks they qualify for a second draw loan whether or not it's useful to apply for an expansion of the initial loan. The fourth and a very important gating issue to getting into one of these loans is that you have to illustrate that you've had at least a 25% reduction in your gross receipts in any of the quarters of 2020 relative to the same quarter of 2019. So a singular quarter where you had a revenue drop of 25% or more in any quarter of 2020 relative to 2019 will qualify for you these second draw loans. Len got into the entities that are eligible, the same entities that were eligible last time, plus the additional entities that that Len mentioned. You cannot get a second draw loan if you get what I'm going to speak about a little bit later, which is a shuttered venue operator grant. These are grants that are designed for theaters and the like who have been basically amongst the hardest hit. They've got a special grant for them, and if you get that grant, you can't apply for a second draw PPP loan. Some other new rules that popped up, and these are not comprehensive, but just two of them are noted. The loan proceeds can't be used for lobbying activities, and you're only going to be allowed one shot have a second draw loan, and that will be it. So what's the maximum loan amount that you can get? So any of you who've seen our prior webinars or have been involved in the process of already getting a P3 loan should know these rules. It starts with, you get the lesser of 2.5 times your average monthly payroll costs, or $2 million. That $2 million cap is way down from the prior cap, but nonetheless, the same base is used, average monthly payroll costs times 2.5%. The average monthly payroll costs can be computed using 2019's payroll, which is what was used, generally speaking, for the initial P3 loans. Or you can use calendar year 2020, or if for some reason you wanted to, you can use the 12-month period before the date in which the loan is made. So for most people, if they've been hard hit, chances are the 2020 payroll is going to be lower than 19. There could be some anomalies associated with that, but generally speaking, 19 may give you your best, highest average monthly payroll, and 2.5 times that, one of those three numbers is what you qualify for the second draw loan, and it's capped out at $2 million. Again, the hospitality industry has really been significantly negatively impacted by the implications of COVID. So Congress put in place a somewhat more generous window of opportunity for a second draw loan for hospitality industries. And if you have the NAICS code 72, then your maximum loan will be 3.5 times the monthly average payroll cost, but the same cap of $2 million is in place. So this is a bit of an advantage that is being provided to the hospitality industry, restaurants, et cetera. The average monthly payroll costs are exactly the same in terms of how you calculate it if you are a hospitality business or otherwise. So everybody is wondering about timing. So back in the spring and in the summer, when we had our initial tranche of P3 money and then the second tranche of P3 money, it was a bit of a foot race for businesses trying to get their applications in, get them approved, and get funded. The first tranche of money went very, very fast. Many businesses were locked out from the first tranche of funds. It was unsettling at best to be in that position. But fortunately, later in the summer, there was an additional tranche of money, and the second tranche of money satisfied everyone who had been waiting for a P3 loan, and then there was actually money left over, and the program closed out with unused funds. It's hard to tell what's going to happen with this funding. This funding is smaller than the initial funding. However, we're dealing with a smaller subset of people who can borrow. So the only folks that can borrow are people who are under 300 headcount and have experienced a downturn in their business of at least 25%. So because of the fact that it's a smaller population that can apply for these loans, and the fact that the tranche of money that's available is smaller, it's hard to say how fast this money may run out. My expectation is that it's going to go very, very fast, and anyone who is in line for or qualified for a second draw loan should be preparing immediately and communicating with their lenders to be in position to be in the queue and get funded as quickly as possible. So when might this all happen? So that's the reason for the timing being important, is because of this foot race to get the money. So the SBA, in accordance with the law, last night or early this morning, issued some substantive guidance regarding how this program is going to run. And within that guidance, there's a number of things that are clarified, one of which is the form that will be used to make an application for a second draw loan. And they make reference to a form that at least I haven't seen yet, and it may exist, but it's, to my knowledge, not publicly available, there's going to be a form called SBA Form 2483-SD, and SD would stand for second draw. My understanding is the lenders may or may not have seen this, but none of the lenders I've spoken to have made reference to the fact that they've seen this form. It will be different somewhat than the initial form because of the different requirements, and there'll be different things that will have to be presented. So the lenders are going to be ready in a uncertain period of time. The lenders that I've been speaking to have suggested that the earliest they can imagine that their windows would be open to take applications would be late next week. More realistically, on the other side of next weekend, which I guess would be the other side of Martin Luther King Day. You may recall in the first go-round, the window opened for lending, and I think there was one or two big national banks that were taking loans, and other banks weren't ready yet. And there was all kinds of confusion at the beginning. My sense is that when these things are ready to go, everybody will be ready to go almost simultaneously, and therefore borrowers need to be in position to get in the queue and get their funds. So now I'm segueing over to the Save Our Stages Act, which is embedded in the new law. Basically, this is designed to help theaters and the like that have experienced a significant downturn in revenue. The standard for which to qualify for this grant is that you have to have suffered at least a 25% decline in earned revenue during a calendar quarter of 2020 relative to the same calendar quarter of 2019. The second point, which seems kind of, I guess, to be understood or assumed, is the eligible recipient must plan to resume its business activities. And what they don't want to do is issue grant money to someone who's already decided to shutter their theater and it's over. They only want to issue these grants to folks who have plans to resume business activities. So I believe that is going to be part of the certification that anyone who applies for this grant is going to have to certify that they're in a position to do that or planning to do that. And then what is the grant that they'll get? It's a pretty significant grant. It's 45% of gross revenue. We're away from the concept now of average monthly payroll. We're now to a gross revenue concept of the eligible recipient. During 2019, maxed out at $10 million. So this this credit, employee retention credit, was in the initial CARES Act. And for most people, including me, it became something I was aware of, but didn't really have wide application of. And beyond the second draw loans, this may very well be the most significant additional resource that hard-hit businesses will have to be able to tap into to benefit from some additional government funding beyond the second draw loans. And in many cases, the employee retention credit could be as big or nearly as big as the second draw opportunity. So let's get into it a little bit. So in the CARES Act initially, excuse me, a company that received the Paycheck Protection Program or P3 loan was ineligible to claim the employee retention credit. So this is the primary reason why most folks just turned the page, they knew it existed, and went on with their business, because the Paycheck Protection Program, as it was designed initially, was much richer than the potential of the employee retention credit as it was designed initially. And basically, in order to get into the situation where you had qualified for this, is you either had to be fully or partially shut down, or your activities had to be suspended by a COVID-19 governmental order. And the period that you could count the wages for to get this credit was only the period that you were shut down partially or fully by a government order. We'll talk more about that item number one, but clearly item number one is a facts and circumstances based window of entry into this program. And I'm not sure, short of a theater or a restaurant that was fully shut down, I'm not sure that there's too many examples of things out there that are just going to be black and white in this area. It's going to be gray in facts and circumstance. The second way in, which is more mathematical and pure, is if the gross receipts of the business were less than 50% of the gross receipts for the same quarter in 2019. So if my, let's say my third quarter revenue or gross receipts in 2019 was 40% of what it was for 2020 was 40% of what it was in, there must be a typo in this slide, there is. So if my 2020 gross receipts are 40% of the 2019 gross receipts, then we would qualify for this. And then that quarter would qualify, and then the remaining quarters qualify until you get back up to 80% of the same quarter in 2019. So the credit then is 50% of wages, and the annual cap was $5,000 per employee annually. So you could, if you had 10,000 of qualified wages and a 50% rate, you got a $5,000 per employee ability. And here's where the previous rules for earned income credit, not earned income credit, for employee retention credit become even stranger. If the company had more than 100 employees, you could only take credit for wages that were paid to employees who were not working. So if you had a restaurant and you were over 100 employees and you were shut down for sit-down service, but you were able to do takeout service and you were over 100 employees, if you had your kitchen staff in there working, those wages wouldn't qualify. You would only get credit for the wages paid to, say, wait staff who weren't working at all. For a company that was less than 100 employees, you would get credit for all of the wages, even if the employee was working. So this made the initial tranche of the CARES Act employee retention credit much less interesting than it is in 2021. In 2021, it's much easier to get, and it's much more lucrative. So let's take a look at it. So come 2021, with the Consolidated Appropriations Act that was just passed, one of the most significant things that they did is that a company receiving a P3 loan is no longer prohibited from claiming the employee retention credit. So that means if you got an initial P3 loan, you could go back and consider an employee retention credit for 2020 and for the first and second quarter of 2021. The 2020 benefits are what I previously described. The 2021 benefits are what I'm going to describe at the moment. So one of the other twists to this, though, is if you qualify for both a PPP loan and an employee retention credit, you can't use the same wages to apply for forgiveness and apply for the credit. You've got to segregate wages between which program you're utilizing. And therefore, your forgiveness application now needs to take into account the benefits that could be derived from the employee retention credit program. And it's important to kind of order these things correctly so that you can get the maximum benefit possible. But, you know, why is this period of time better? So the first thing is that the gross receipt standard is now 80% instead of 50%. So this employee retention credit in 2021 is available to anyone who had a drop in gross receipts of 20%. And the quarters that we're utilizing here are the prior quarter of the fourth quarter of December, ended December 31, 2019, or the current quarter in 2021. So anyone who qualifies for a second draw loan should also qualify for the the employer retention credit. And the other change, which was significant, is now the credit is applicable to 70% of wages. So in the past, the max was 50% on 10,000. Now it's 70%. And that 70% applied to 10,000 is available for each quarter. So in 2020, you had a 50% opportunity against 10,000 in wages as an annual limit. And now you've got a $10,000 wage base multiplied by 70%, or $7,000 that's available for each quarter of 2021. So what this means is there's a possible credit for folks who qualify of $14,000 an employee, which is available. This can be very significant. I was talking with a client recently who had an initial P3 loan of about $2.5 million, was qualified for and applying for a second draw loan. And in addition, we talked about this credit, and that particular taxpayer qualifies for roughly a $1 million employee retention credit for each quarter, the first and second quarter of 2021. So this can be really significant. And going back to the ordering and forgiveness, you have to coordinate your forgiveness application with considering, obtaining the benefit, the maximum benefit from both the employee retention credit as well as the loan forgiveness. The other thing that changed, which was a significant benefit, is the threshold for a small versus large employer went up from 100 to 500. So now any employer in 2021 who had a 20% drop or more in their revenue and is under 500 employees qualifies for this credit. So it's a big window of folks who potentially are in a position to derive this benefit. And this has been a bit of a sleeper provision that a lot of people haven't been talking about too much. Most people have been focused on the Paycheck Protection second draw loan, in part because this program was more or less neutered in the first round because you couldn't have both a Paycheck Protection loan and the employee retention credit. So just to repeat what we said earlier, if you're under 500 employees, you can count wages that apply for the credit even if the employers are working. So that's creates a bigger window of opportunity to make the calculation. And the last item that I'll mention here is that the credit, whatever it is you obtain, that credit will be a reduction of tax deductions in the year in which the credit is received. So if I receive $1 million credit, that's a dollar for dollar benefit that I can derive, but I have to reduce my wage expense on my income tax return by $1 million. I didn't get into it in detail in this analysis, but the way that this credit will be derived will be an advance payment or a check. The mechanics of this have not been fully determined, but you could, in theory, be applying right now for the first quarter's credit of 2021 based upon the outcomes that you had in the fourth quarter of 2020. The form you're going to use is Form 7200, and you'll file it once the regulations are defined exactly how we do this, and you'll receive a you'll receive a check for the amount of the credit that you qualify for, and it'll be trued up for on your employment tax 941 filings. So there's a lot of money at stake here, and it can be not quite as big, but almost as big as the second draw P3 loans. So we have a little bit of time left. Jesse, I don't know if there are questions that...
Yes, we have a handful of questions, actually. And we did receive a handful of questions specifically relating to how to calculate gross receipts for the P3 second draw, whether it's cash or accrual basis, or in general, how are those gross receipts measured?
So yesterday at this time, I couldn't have answered that question. Thanks to the information that came out late last night or early this morning, I can. the SBA has clarified that you're going to use your gross receipts as per your tax method of accounting. So if you're a cash method taxpayer, you're going to use cash for accounting for it. And if you're an accrual method taxpayer, you'll use accrual accounting to determine that. But it's a question we've been asked quite a bit. It's a good question to put on the floor because it's now been clarified.
Great, thank you. And another question, we received several relating to when is a good time to apply for forgiveness for our first initial P3 loan?
So that's another good question, Jessica. And, you know, I think now that we're getting clarity and more clarity about what's happening, you know, if you are not going to qualify for, you know, additional monies on the first loan because you were a seasonal employer or partnership, you know, and you don't have any significant, you know, ongoing complications, it may be worth considering moving forward with that application now. There still may be some reasons to consider waiting for some additional guidance from the SBA here and how it may interact with some of these other law changes. But, you know, I think from my perspective, I'm less concerned about continuing to wait here, especially if you're not going to qualify for the second program and you're not going to qualify for the employee retention credit. Bill, do you agree with that?
Yes, I agree with that. And we have been generally advising folks to take their time with respect to filing forgiveness applications, and unless there was some compelling reason to accelerate that process, because we had for months been expecting this second tranche of legislation to come along and expected that there would be some clarity that would come from the second tranche of legislation. And clearly there has been some clarity, and not just clarity, but potentially some additional complications when you interweave wages qualified for both the employee retention credit as well as the P3 loans. So I think, you know, we're at a point in time now where we have almost all the guidance I'd like to have to be filing forgiveness applications. We have some additional information that's coming shortly about how the IRS plans to, not the IRS, the SBA plans to audit forgiveness. I'd like to actually read that and understand that before we file some of the bigger applications. But short of that, I think most folks should be in a position where they can file forgiveness applications now.
Thank you. Another few questions related to the employee retention credit, and can you or does that change in ruling apply to only the second draw P3 loans, or does it apply to the initial P3 loan as well?
Yeah, so it's a good question. So it applies retroactively. So the initial CARES Act that came out indicated that that the P3 loan, initial loan, which was the only thing that we knew of at that point in time, it wasn't called an initial loan, was mutually exclusive with the employee retention credit. Now with the new act, even if you're not going for a, well, let's put it this way, if you went for an initial loan and or if you went for a second loan also, in either case, you can qualify for a employee retention credit. So having one or both P3 loans will not exclude you from being entitled to the employer retention credit to the extent you qualify for that.
Perfect. We do have a handful of questions also relating to whether or not the second draw or amended first initial P3 loan has to be with the same lender as one that was previously received.
Yeah.
So Bill, maybe I'll handle it first from the additional proceeds on the initial draw. You know, those would go through the same lender because that's who you have the loan with. So you would need to go back through that process with the initial lender to modify that loan and get the increase. And Bill, you could handle the second draw loan question.
Yeah, thanks, Lynn. There's nothing that I've read in the law and or the guidance from the SBA that requires you to go back to the same lending institution for a second draw loan. To me, it's logical that you would, assuming that the lender is in a position to move as quickly as you are. But I have not seen anything that requires a business to go back to the same lender.
Okay, and I think we might have time for one more question. Is there an impact that the P3 will have on state taxes? Or will state taxes also recognize the P3 as non-taxable? Do we have any guidance on that at this point in time?
So I'll handle that one. I think we're going to have to wait and see for some states. A state like New Jersey, where based on their laws, it shouldn't be taxable and we shouldn't have an adjustment. They've recently announced that they're taking a second look at it to determine whether they're going to follow and comply with the federal treatment. So we're going to have to wait and see. In a state like New Jersey, they could come to an alternate conclusion, even though based on their current law, they really shouldn't. Other states may decouple from the treatment as well. So we're going to have to. We're going to see this develop over the coming months, I guess, is probably the best way to answer that question.
Thank you, Len. Possibly one more question that we have time for before we close out today's program. But are there any restrictions if a company has a certain amount of assets for the ability to apply for a second draw loan?
So the standard to apply for an initial loan or a second draw loan is similar in that in the initial loan you had to have at the time of the application enough economic uncertainty to require the loan as being necessary to fund the continuing operations of the business. Those words are all kind of fuzzy and general. So total asset size, I don't think would necessarily prohibit someone per se from either a first or second draw loan, but it could be something that's considered when you're considering whether the loan was necessary in the first place. Maybe net equity might be a more compelling number than total assets. But the only standards that are there that are required for eligibility for a second draw loan are the number of employees and the reduction in the revenue.
Yeah, just to piggyback that as we're closing up, Bill, I also think you need to look at liquidity as part of determining whether the loan is deemed necessary. And it seems like the SBA may be targeting that. So looking towards liquidity, what's the cash in the bank? What are your liquid assets that could be turned over quickly? They may look towards that in helping to determine whether or not there is a necessity for the loan. But as you said, it is loosely worded and not very clear, and there's no bright line test, so it's more of a subjective test in nature.
Thank you. So I apologize to everyone as we don't have time to get to every additional question as we've hit the 1 hour mark of our presentation. We will review your questions and do our best to contact you back with a response, however, as soon as possible. So that does conclude our webinar today. If you would like to refer back to the recorded version of today's program or share it with your colleagues, the recording and the slide deck will be available within a few hours on our website at wgcpas.com. Thank you again for joining us, and we hope you have a wonderful day.